Welcome to Pip Insight Macro, the economic calendar briefing for the daily Forex news. Today is the 14th of July, 2026. This session has 6 high-impact and 1 medium-impact releases coming up. Let's run through exactly what's on the calendar and what it means for the major currency pairs. Welcome back to Pip Insight Macro, your daily Forex news source. I'm your lead analyst, and today we're tracking 6 high-impact events that could shake the markets. Our focus? The yen crosses, dollar yen, euro yen, pound yen, and Aussie yen are all in play. We've got BOE Governor Bailey speaking, plus crucial data from Japan and China. Let's break down what matters. Here is the full economic calendar for the daily Forex news. We have 6 high-impact releases due this session. Let me walk you through each key event and what it could mean for the markets. We're tracking a high-impact speaking engagement from Bank of England Governor Andrew Bailey today, and this is significant for pound traders everywhere. Bailey's commentary on inflation, rate policy, and economic conditions can shift market expectations around future BOE decisions in seconds. This is one of those events where his tone and forward guidance can move British pound across multiple currency pairs simultaneously. When the BOE governor speaks publicly, markets are essentially listening for clues about the central bank's thinking on interest rates and monetary policy direction. Bailey's remarks matter because they can signal whether the BOE is ready to hold rates steady, cut further, or potentially hike, and each of those scenarios moves sterling in different directions. A hawkish tone, suggesting higher for longer rates or stronger growth outlook, typically strengthens British pound as investors seek higher yields. A dovish tone pointing to economic weakness or rate cuts ahead typically weakens sterling. The pound has been volatile recently amid mixed UK inflation and growth signals, so traders will be parsing every word for clues on the BOE's next move. Watch for specific language around inflation persistence, labour market strength, and domestic demand. If Bailey sounds confident inflation is under control and hints at patience on cuts, we could see British pound bid higher across the board. Conversely, any concern about growth or wage pressures could trigger selling. Price action traders should monitor the first 30 seconds after his opening remarks, that's when initial positioning happens, and watch for breakouts above or below recent. We're watching Core CPI month-over-month data dropping today, and this is a critical inflation metric for the Federal Reserve. The forecast is holding steady at 0.2%, matching the previous reading, but any deviation could send shockwaves through the dollar. This is one of those high-impact events that can shift currency valuations in minutes. Core CPI strips out volatile food and energy prices to give us the real picture of underlying inflation pressures in the US economy. This matters enormously because the Federal Reserve uses this data to guide monetary policy decisions. Rate hikes, rate cuts, and forward guidance all hinge on inflation trends. If we see a beat above 0.2%, that signals stronger inflation persistence, which typically supports a stronger dollar as markets price in higher or longer-lasting rates. Conversely, a miss below 0.2% suggests cooling price pressures, which could weaken the dollar and spark risk-on moves. We're coming off a period where inflation has been gradually moderating, so traders are watching closely to see if that trend holds or reverses. The key price action to monitor is immediate volatility in the first 60 seconds after the print. That's where the real institutional flow happens. Dollar strength or weakness in the minutes following the data release often sets the tone for the entire session, so keep your eyes glued to your charts. Euro, we're tracking Core CPI year-over-year data coming in today, and this is a critical inflation gauge that the Federal Reserve watches closely. The forecast is calling for a dip to 2.8% from the previous 2.9%, which would signal cooling price pressures in the economy. This number matters enormously because it directly influences Fed policy decisions and dollar strength across all major currency pairs. Core CPI measures inflation excluding volatile food and energy prices, giving us the clearest picture of underlying, persistent price trends in the economy. The Fed uses this metric as a key pillar in their rate-setting decisions because it reflects actual demand-driven inflation rather than commodity shocks. If we see a beat, meaning inflation comes in hotter than 2.8%, it suggests the Fed may need to hold rates higher for longer, which typically strengthens the dollar as investors seek higher yields. Conversely, a miss below forecast signals disinflation, which could prompt Fed easing and weaken the dollar. We're coming off a 2.9% reading, so we're watching for that incremental move lower as confirmation of the disinflationary trend that's been building through the year. Watch for big moves in the first minute after the release, particularly around key technical levels in dollar index futures, as algorithms and hedge funds front-run the initial volatility spike. Euro dollar and dollar yen are your most sensitive. We've got a major inflation print hitting the wires today, the monthly consumer price index, or CPI-MM. This is one of the most closely watched inflation gauges in the world, and the Federal Reserve uses it to guide interest rate decisions. Today's number could spark some serious volatility across the dollar complex, so let's break down what's at stake. The CPI month-over-month measures the month-to-month change in prices that consumers pay for goods and services. It's the real-time pulse of inflation pressure in the economy. The forecast is calling for a -0.1% reading, which would be a disinflationary move compared to the previous month's +0.5% print. This matters enormously to the Fed because softer inflation readings support the case for holding rates steady or even cutting in the future, while hotter prints would argue for staying higher for longer. If we beat expectations and see deflation or weakness, you'd typically expect the dollar to weaken because lower inflation reduces the appeal of holding dollar assets and supporting US rate premium. Conversely, a miss, meaning stronger inflation than expected, would support the greenback as traders reprice Fed hold probability higher. We're currently in a disinflationary trend after months of elevated readings, so today's data will either confirm that momentum or signal a reversal. Watch for price action around key support and resistance levels in the first 30 minutes post-release. That's when the initial flow hits hardest. We've got a critical CPI report hitting the wires today, and this is one of the economic releases that moves markets in a big way. The US Consumer Price Index year-over-year is expected to cool from 4.2% down to 3.8%, suggesting inflation continues its gradual descent toward the Fed's 2% target. This single data point can shift the entire narrative around interest rate policy, which directly impacts the dollar's strength across multiple currency pairs. The CPI year-over-year measure tracks inflation in the prices consumers pay for goods and services compared to the same month last year, and it's the Fed's North Star when making monetary policy decisions. A beat to the downside, meaning inflation comes in lower than expected, typically signals progress in the Fed's battle against price pressures, which could support a more dovish stance and potentially lead to rate cuts down the line. Conversely, a miss or sticky reading above 3.8% would reinforce the idea that inflation remains stubborn, keeping the Fed cautious and supporting the dollar. What's important here is the trend. We're seeing a multi-month improvement, but we need confirmation that disinflation is continuing, not stalling out. For the dollar specifically, weaker inflation readings tend to weigh on US dollar strength because they reduce expectations for prolonged elevated rates, while stronger readings do the opposite. Watch for volatility immediately after the release and pay attention to whether the market reprices Fed rate cut odds. That's where the real currency moves happen. Euro dollar and pound dollar are your two most sensitive pairs here. Fed Chairman Warsh is set to testify before Congress today, and this is a high-impact event for currency markets around the world. His remarks will give us crucial insight into the Federal Reserve's current thinking on interest rates, inflation, and economic growth. Traders are paying close attention because any signals about future monetary policy can cause significant moves across major dollar pairs. When the Fed chairman testifies, he's essentially communicating the central bank's policy stance to both Congress and the markets. This testimony can reveal the Fed's inflation outlook, their assessment of labor market strength, and their willingness to adjust rates in coming months. A hawkish tone, suggesting higher for longer rates or concerns about inflation, typically strengthens the dollar because it makes US assets more attractive to international investors. Conversely, dovish commentary suggesting rate cuts ahead would likely pressure the dollar lower. the market impact depends heavily on how Warsh's remarks compare to current expectations. If he sounds more hawkish than anticipated, we'd expect dollar strength across the board, pushing euro-dollar and pound-dollar lower while dollar-yen and dollar-Swissy move higher. If he sounds more dovish, the opposite occurs. Traders should watch for specific language around the terminal rate, the inflation trajectory, and any forward guidance about future policy adjustments. Given recent economic data and market positioning, volatility could spike immediately following his opening remarks. We're tracking a high-impact speaking engagement from Bank of England Governor Andrew Bailey today, and this is significant for pound traders everywhere. Bailey's commentary on inflation, rate policy, and economic conditions can shift market expectations around future BOE decisions in seconds. This is one of those events where his tone and forward guidance can move British pound across multiple currency pairs simultaneously. When the BOE governor speaks publicly, markets are essentially listening for clues about the central bank's thinking on interest rates and monetary policy direction. Bailey's remarks matter because they can signal whether the BOE is ready to hold rates steady, cut further, or potentially hike, and each of those scenarios moves sterling in different directions. A hawkish tone, suggesting higher for longer rates or stronger growth outlook, typically strengthens British pound as investors seek higher yields. A dovish tone pointing to economic weakness or rate cuts ahead typically weakens sterling. The pound has been volatile recently amid mixed UK inflation and growth signals, so traders will be parsing every word for clues on the bow's next move. Watch for specific language around inflation persistence, labour market strength, and domestic demand. If Bailey sounds confident inflation is under control and hints at patience on cuts, we could see British pound bid higher across the board. Conversely, any concern about growth or wage pressures could trigger selling. Price action traders should monitor the first 30 seconds after his opening remarks. That's when initial positioning happens, and watch for breakouts above or below recent. We're looking at Japan's revised industrial production month-on-month data, which gives us a clearer picture of manufacturing activity in the world's third-largest economy. This revision can sometimes shift market perception, even if just slightly. The revision came in flat at 0.5%, matching both the forecast and the previous reading, so we're not seeing any surprises here. With no directional shift in the data, expect muted volatility across the yen pairs today. This is the kind of event that typically confirms existing trends rather than creates new ones. We've got German wholesale price index data hitting the wires today, and while it's classified as low impact, it still gives us a window into inflationary pressures moving through Europe's largest economy. This month-on-month reading is a leading indicator that traders watch closely when building their macro narrative around the euro. We're looking at a forecast of 0.5% month-on-month, which would be a notable swing from the previous -0.6% decline. That's a shift from deflation back into positive territory, suggesting some upward price momentum at the wholesale level. Given the low-impact classification, we shouldn't expect dramatic volatility, but any significant miss could still nudge euro pairs as it feeds. We're tracking a French bank holiday today, which means financial markets in France will be closed for the day. This is a scheduled closure that typically has minimal impact on broader Forex trading, but it's worth noting for your market analysis. With French banks shuttered, liquidity in euro pairs may be slightly reduced, particularly for trades involving French counterparties. However, the overall market impact is expected to be low since this is an anticipated event and most major trading hubs remain open. We might see modest volume decreases in certain euro crosses rather than directional price movement. Based on today's releases, the pairs most at risk of volatility this session are dollar-yen and euro-yen and pound-yen. Here is a breakdown of why each pair is in focus. That wraps up the complete daily Forex news economic calendar breakdown. The key theme today is yen volatility across multiple pairs today. Keep a close eye on the release times. A surprise deviation from forecast is often where the real moves happen. This is educational content only. Trade safely and manage your risk. That's your daily Forex wrap. Don't forget to like, subscribe, and follow us on X at Forex Insight for real-time market updates. Thanks for watching Pip Insight Macro.